This video is to be used for educational purposes only and is not intended to replace individual research or licensed investment advice. Unique experiences and past performances do not guarantee future results. Trading stocks, options, and spot currencies involves substantial risk. There's always the potential for loss. Your trading results may vary. No representations are being made that any software or trading will guarantee profits or not result in losses from trading.
Good afternoon, traders. I'm Daryl Richburg, and this is your Forex report for March 2nd, 2007. Most of the majors struggled to find their whole direction this week, with the exception of a few. As commodities such as gold fell sharply, so too did the Australian and New Zealand dollars. Of course, from a technical standpoint, it was the yen's tremendous rally that led to such weakness in most currencies. There was a great deal of U.S. data released this week, but none of it seemed to get traders too excited. Numbers such as new home sales and durable goods orders were very disappointing, while existing home sales and GDP came in above forecast. Of course, forecasts have not been incredibly optimistic, which makes better than expected numbers less of a dollar positive. Other numbers that came in a little better than expected include PCE and ISM manufacturing. Ben Bernanke may have helped alleviate some fears this week as he stood behind his mid-February Humphrey Hawkins testimony, where he said that the economy is sound and should begin to pick up toward the middle of the year. He downplayed this week's GDP revision by saying that it was more than in line with what the Fed had originally expected. Nevertheless, futures traders are already pricing in a 100% chance the Fed will cut rates by July. Of course, the further out these contracts trade, the more sensitive they are due to light volume. Many economists still believe the FOMC will not lower rates at all during 2007. In the big picture, the yen is taking the spotlight and may not be giving it back right away. We have seen carry trades unravel at a steady pace, and many are now wondering if this is just the beginning. The Japanese government has shown very little concern over this week's yen strength, but can change its tone very quickly if the currency continues to push higher. The yield differentials between Japanese government bonds and those of other G7 nations narrowed dramatically this week as traders grow more confident in further BOJ rate hikes. Reports this week also indicated that Japanese investors are keeping more money at home, and demand at bond auctions jumped significantly. Furthermore, the fiscal year end for Japan is March 31st, which normally prompts investors to repatriate funds. These are all yen positives. However, there are some indications that the carry trades could come back into favor sooner than later. A report of currency options this week showed that investors paid the highest premiums in months to buy yen call options. Institutional investors were heavy buyers of these options, which appreciate as the yen rises. Of course, the reason behind the heavy buying of these contracts was to avoid having to liquidate short yen positions in the spot market. This tells us that many big players expect only a temporary pullback. We are certainly not ruling out another leg higher in the yen, but also believe that disappointing data and/or stern words from Japanese government officials could give the carry trade a sudden breath of life. Until next time, this has been Forex Report.